Most investors lose money for one reason that almost no one wants to admit. They're paying attention to the wrong signals. They obsess over headlines. They argue about whether the economy feels strong or weak. They wait for clarity that never arrives. And when a move finally looks obvious, they aren't unlucky. They're late. Markets don't move because people feel confident. They move because money becomes cheaper or more expensive. That's it. No mystery. Yet most investors refuse to anchor themselves to the one variable that actually drives outcomes. So they panic during pullbacks, freeze during rallies, and tell themselves they're being careful, when in reality they're just lost. That confusion won't be punished gently. It will be punished quickly. Rates are shifting, liquidity is changing direction, and the people who understand how that transmission works will look brilliant in hindsight. Everyone else will blame manipulation, bad luck, or bubbles. If you've been wrong before, this is where you find out why. While markets have been moving, life has been moving too. Time passes whether you're watching charts or not. And the point of building capital isn't to stare at a screen forever. It's to build systems that keep working while you live your life. That's the difference most people miss. They chase predictions, they argue scenarios, they wait for permission. Others build frameworks that don't require constant supervision. That's what real freedom looks like. Not stress-free markets, but enough financial firepower that life isn't postponed until someday. The data right now is clear. The opportunity set ahead is large, but only for people who understand what actually moves markets. Here's the mistake most people make. They think markets should fall because life feels expensive. Groceries cost more, rent is heavier, budgets are tight, so they assume stocks must collapse. That logic is backwards. The market does not care how your wallet feels. It cares where capital flows. In every major cycle, this has been true. When rates fall, money moves. Not because it wants to, because it has to. Cash stops paying. Bonds stop compensating for risk. Safe assets quietly become losing propositions, so capital rotates. That's why markets often rise during periods that feel uncomfortable. Not because the world is healthy, but because returnless assets become unviable. Money does not sit still, it relocates. If you're waiting for the economy to feel good before investing, you're already behind. The market doesn't wait for confidence, it punishes hesitation. This isn't a rigged game against you, it's a system you haven't learned to read yet. When rates shift, the system reprices immediately, not after months of commentary. Not after consensus forms. The first flows start the moment the incentives change. Most people see the headline and do nothing, not out of laziness, but because they're still thinking in old cycles. They believe there will be time to reposition once it's obvious. There isn't. By the time it's obvious, it's crowded. Liquidity doesn't ask for confirmation. It moves first and explains itself later. That's what makes it dangerous. A small rate adjustment on paper is not small in reality. It changes the math across the entire system. It redefines what risk is worth taking. You don't need to chase moves. But if you're still sitting frozen, be honest with yourself. Are you being cautious or are you just stuck? Because the money is already moving. And in environments like this, delay has a cost. You can follow earnings, you can analyze charts, you can consume endless news, and still miss what matters. Liquidity is not a metric, it's a current. When it flows in, assets inflate. When it flows out, they sink. It doesn't care how strong a company is or how logical the story sounds. Liquidity lifts everything. Good, bad, overvalued, misunderstood. You've seen this before. Markets exploded in the aftermath of crises not because conditions improved, but because capital flooded the system. That pattern hasn't changed. Every major run of the last decade started the same way. Not with optimism, not with economic perfection, with liquidity. If you aren't tracking that, you aren't investing. You're reacting. And the market has no sympathy for reaction time. You don't have to like the institutions that control the system. You don't have to agree with how it works. But denying reality doesn't protect your capital. There are only two options: complain about the rules or learn to operate within them. The people who spend their time raging against the system aren't outperforming it. They're watching it move without them while waiting for fairness that never arrives. Meanwhile, others quietly adapt and move on. A weakening currency feels awful in daily life. Your money buys less. That pain is real. But that same pain is what pushes capital into markets. When cash loses purchasing power, holding it stops making sense. Fixed income lags, savings erode quietly. Large allocators don't debate this. They reposition. That's where things get counterintuitive. Holding cash feels safe. It feels responsible. But inflation turns that safety into slow erosion. So money rotates into assets that can outrun dilution. Stocks, real assets, anything that doesn't sit still while value leaks away. At that point, you're not chasing returns. You're defending purchasing power. And waiting too long makes re-entry expensive because the currency itself has weakened. The safety most people cling to isn't neutral, it's corrosive. Everything leads to this decision point. Rates are easing, liquidity is increasing. The system has already shifted. Now the question is, what you do with that information. The next major opportunity is still concentrated in technology and artificial intelligence. Not as a theme, but as infrastructure. Hardware, platforms, and the companies embedding intelligence into everything they touch. How you approach that depends on who you are. Some investors want to be active, focused positions, high conviction, disciplined execution. Others want broad exposure, diversified vehicles that capture the trend without constant management. Some prioritize growth with lower volatility, others care only about preservation. None of those approaches are wrong, but doing nothing while the system moves is. Capital is already rotating. You can follow it, or you can keep calling stagnation prudence. Just don't lie to yourself. Don't call fear caution. Don't call paralysis strategy. Because while you're debating, someone else already acted, and they're building a future you'll later call lucky. This isn't about hype, it's about understanding how money actually moves. Once you do, the noise fades, the panic disappears, and the market stops feeling random. The rules were always there, you just weren't shown them. Now you have a choice.